times on that, but we want to focus really on, the commodities today because there's so much happening. We have breakouts that we've been talking about in the gold market, also in silver started, and also, my goodness, I think there's so many of them. I see crude oil, gold, silver, and a few others that we want to really talk about. But the first one that I wanted to mention that we talked about yesterday, and that's the natural gas. We want to watch this contract, very, very closely because it's cheap to trade, and it actually has some tremendous moves in it. It's been down, making new lows for 21 years, and right now we are at the, completing a big AB equals CD on the weekly chart down at that $2.20 per cubic feet, and we've had a pretty good rally, off of that. And so what we're trying to do now is to keep an eye on the first retracement, and we've had several of those at the 786 retracement over the times that we've been, talking on air and just watching those work. And we're having another one, right now, very similar to the others that we've had. And I think it's informative, I think, because if we can show folks how some of these patterns hold up as far as support and resistance at these levels, it gives you a good idea that these numbers are just not random, that they occur all the time. And if you get a chance to go into Tiger TV and look at these two charts, first was the weekly chart for natural gas showing the large AB equals CD completing down at the 220 level. And then we've had, since the middle of January, we've had a series of big swings, all culminating at the 786 level on the high side and 786 level on the downside. And that's put us in a trading range between 240 and 275. And then last night, or actually yesterday's show, when we were talking about it, it was making an exact 61% retracement at the 254 level, and it rallied 17 cents, which is quite a bit of money. That's $1,700. And it stopped exactly at the 786 of the previous high. And now what's happened is when we do that, we are forming a really tight triangle, and that's what's looking at. So we have support at the 245 level again, and then we also have resistance up around 275. But above 275, I believe we'll be breaking out to the upside, and this has a chance to really have a pretty good move. And if this breakout that we're having in crude oil is correct, we're going to have really, a good idea of what natural gas might do, because we're going to have to be looking at alternative energy if we get crude back to that 120 level per barrel. That makes a tax on everybody because we all use the oil so much. So we were watching this just for, potential buy. Right now, looking at that 30-minute chart, we've come down to support at that 257.5 level. So we'll just have to wait and see, what happens with the next part of this. So that's the main thing that we want to keep an eye on the natural gas. It's very important because, we all use energy, and this is what we're really looking for. Now, because this is the commodity hour, we've got some really, like I mentioned before, we've got some really powerful things happening potentially in these markets, and I think the best way to look at it is use one of the biggest, of all the commodities that everyone looks at to trade, and that happens to be the crude oil market. And we have been, talking about this market for a long time, especially at the support at 92 and the support again at 94, at 95, and the fact that we've gone up and we've made our targets now up in this level at the 106.50 level, and that's where it's trading right now, right at the 786. The difference is that this time the market gapped up on Monday, actually Sunday night, when the rest of the world was not celebrating, our President's Day's holidays. It was the news of supposedly Syrian uprising or whatever they want to, they give you all different kinds of reasons for whatever happens. But frankly, what we're looking for is that we did gap up, above that number on Saturday, we mentioned many times that if the oil got above the 103.50, that set the first set up at least between 107 and 114, and we can easily achieve that now because it's gone $10 per barrel in 10 days. That's $1 a barrel. So if we keep doing that, you can imagine where we could be in 20 days. Now, it'll probably take some type of an uprising in order for that to happen. But at least what we're looking at now is that we're standing at the place where major resistance is either going to give way, or this is going to be a false breakout in the crude oil. And frankly, with that gap up Sunday night and the fact that it's been up here several times, it looks like it certainly wants to move higher. And I wouldn't fade it by by selling it here. But we need to look. When you're trading at commodity markets, the oil breaks down into heating oil and also into gasoline futures, which run our cars, and so we need to look at those also. So the next one we're going to take a look at is we'll take a look at the the gasoline futures, and we wanted to show the folks that we've been following this for an awfully long time on the commodity show. It's had the big head and shoulders pattern, and then we had the huge breakdown, completing the head and shoulders bottom. And what we're doing now is that we are coming back and we are making a 61% retracement on the big move down. In other words, from $3.50 a gallon all the way down to $2.44 a gallon. We're now up to $3.09 a gallon, and that's it makes a 61% retracement of the whole move. And so you can see that these are fitting together. You're right at the 786 level in the crude oil. You're right at the 61% retracement in the gasoline futures. And then we need to look at the third component that we have in the market, and that will be the heating oil futures. And remember, we are having an incredibly warm winter here in the East. I happen to be in the East right now, and it's almost shirt-sleeve weather here in February. So we've had a case where we've not really had very much of a problem with any weather at all. And all we're doing now in the heating oil is we are making a very large double top up at the $3.28 per gallon level in the heating oil. Now, if that's going to be a double top, we could easily break that out and go a lot higher if we want to. But we are just at such a critical level here in the crude oil, the gasoline futures, and also the heating oil themselves. So this is why these breakouts are important. When we get to these spots where they have all the numbers coming together and all three components, that's telling you that it's really important, because when they go, they most probably will go together. If you remember back in December when we were looking at these buy points in the crude oil at 92 and also again at 95, we're watching the divergence between these components of the crude oil markets, and they were also telling us that they were making higher bottoms, giving us a bullish bias. This went right along with that DBA, that commodity ETF that we followed, that stopped exactly at the 61% retracement several weeks ago, and it's continued higher, ever since that time. We've been moving higher, all along this whole last few weeks, and so this is telling us that we have a positive bias, at least for commodities. And so the thing that I'm trying to alert you to today is that we are at a really, really critical spot with a lot of these commodities. Now we really have to look at gold and silver. I want to spend more time on that when we get after the break, but we really need to really get to that, because I had several emails talking about silver finally went above that 34.50 level that we had looked at and broke out of the resistance that was there. Gold had already done it. We talked Friday. Excuse me, this is Wednesday. I lose track of time. This is Thursday. But on Wednesday's show, we talked about, gold was ready to break through that 1770 level, which was the 61% retracement of the last high, and it did that with relatively ease in 2 days. We're now about $17, $18 higher than that. That tells us that we're going to most probably, go to the next level, which is $18.35 in the gold market. So I really believe that it looks like we have, broken out of here. And the other reason why that gold could be extremely bullish is that, it only backed off about $60 an ounce after making that 61% retracement. And that's a very, very, small amount, when you're looking at gold. That's not even close to a 382 retracement. In fact, I don't even think it's more than about 18% correction after the low we made down at the double bottom, in December. So this is telling us that we have broken out to the upside, both in gold and in silver, and it looks like we are in the process of, heading toward $1,837 per ounce in the gold market. Now, we probably are not going to get there, straight up. There's going to be backing and filling in between here, but frankly, this is what's happened right now. It looks like it is broken out, and we have to, respect that, because you don't want to, stand in front of it. Once it breaks out of these Fibonacci numbers, it can certainly move, a long way in that direction, and you don't want to stand in front of it. So that's the main thing. Now, a lot of this that we have is related to the U.S. dollar and the euro and the Japanese yen, and this is something that we need to talk about. We're probably getting ready for a break if my computer time is right, so I'll just add a few things here. Today's show, I'm trying to feature as many of the 618 and 786 retracements on all of the charts that I'm putting into the Tiger Den. The reason for that is that these are the numbers that I use all the time. 618 and 786 are retracement patterns, either on the downside or the upside, and 1.27 and 1.618 are expanding patterns. 877-927-6648. Johnny Carson, I will never be.
In just December of last year, the price of gold was down over 10%. In today's highly volatile gold market, you need someone in your corner that understands the complex relationships that exist within the price of gold, as well as within a variety of gold equities. Whether it's the South African gold miners and knowing how the Rand-dollar relationship will affect their bottom line, or understanding how John Paulson's $5 billion trade in the GLD can move the market, Tom O'Brien gives you the direction you need to become a better trader each week in his newsletter, The Gold Report. With over 20 individual equities covered and almost another 20 on the potential watch list each week, in addition to covering the XAU, HUI, GLD, and dollar, The Gold Report is a great source for any trader that is looking to be diversified in today's volatile gold market. For your 30-day free trial to Tom O'Brien's Gold Report, log on to TFNN.com today. Don't miss out on this great offer. Act now. You've always taken the long view when it comes to investing. But what if there's an opportunity right under your nose? What if you could be more responsive to market trends to seek to boost your portfolio performance right now while actually reducing your overall risk? At Direction Funds, we connect investors with alternative strategies that seek to maximize their returns, making missed opportunities a thing of the past. Smart investors deserve smart alternatives. Find yours at directionfunds.com. An investor should consider the investment objectives, risk charges, and expenses of Direction Funds carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Funds. To obtain a prospectus or summary prospectus, please contact the Direction Funds at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. Investing in index funds may be more volatile than investing in broadly diversified funds. Distributed by Rafferty Capital Markets, LLC.
Hi, I'm Steve Rhodes, co-host of The Money Masters with Tom O'Brien, seen daily at TFNN.com, author of Mastering Probabilities, a daily investment and trading newsletter, and teacher of the money game. Studies show that 3 out of 5 people are afraid for their life in trading these markets, and the number one reason given is fear of loss. Look, fear stands for false evidence appearing real, and the money game proves it. Lesson number 1, don't risk more than 1% of your trading capital on any trade. Why, you ask? Because 35 trades in a row where you risk 50 cents and make $1 are all you need to double your trading capital, versus the 230 losing trades in a row you would need to bring your balance to $100. Let me teach you more about the money game risk-free for 30 days. Go to the homepage of TFNN.com and click on my name, Steve Rhodes, for your 30-day risk-free trial. You were born to be a money master, and I'll teach you how.
X-Story Gold Mines, an NYSE Amex-listed company trading under the symbol XG, is slated to be the newest gold-silver producer in Argentina. X-Story is forecast to produce more than $250 million in bullion annually, beginning in 2013, at a cash cost of less than $200 for each ounce of gold produced. That forecast will make X-Story one of the highest margin operators in South America and a sector leader in the mining industry. X-Story has $50 million in its treasury, having spent over $60 million to date on drilling and engineering. The ultimate size of its Argentina discovery could be determined by year-end, as results from the 6 drills operating at the site are fully assessed. To find out more about X-Story Gold Mines and their exciting growth potential, click on their banner on the front page of TFNN.com or check them out on the NYSE Amex under the symbol XG.
This segment is brought to you by Great Panther Silver. For more information, just click the Great Panther Silver banner on the front page of TFNN.com. Now, back to the Futures Hour.
Okay, we're back, folks, and this is the Futures Hour for TFNN, 877-927-6648. If you have any questions, I'll be happy to answer them for you. I happen to be back east here doing a little bit of research on cycles and things and learning a lot. But I want to get back to the silver market because, we have broken above that $34.25 per ounce level that held for several weeks. We're now $1 above that. And it looks like, the next stop on silver should be around 37.5. Now, the question is whether we're going to attempt the old highs or not, up around 49. We'll just have to wait and see. My memory is pretty good from what happened in 1980. And after we topped at that 40, actually we hit $54 an ounce level in 1980, and then the market broke a little bit and then had a little 61% retracement back. And then, of course, fell down to around, I think it got down below $4 an ounce during the lows of 2002, 2003. So, it's one of those little wild swinging markets, so we'll just have to, see what it's going to go to the upside. But right now it is broken out to the upside. And that's apparent to what's happening in the the DBA. When we first started to point this out about a month ago, when the DBA hit that exact 61% retracement, that was the first indication, that the market was going to look like some of these commodity markets had bottomed, and crude was at 92, and beans were right at the exact 618, and corn was, trading at the 618, and wheat was at the 618, and all of these have had really strong rallies, coming off of these levels. So this is why we want to, keep looking, the fact that they are going up, and it's one of the indications that tells us that we have to be, watching, where we go. Now, what I'd like to do now is to talk a little bit about the grain markets because, we need to look at corn for sure because it is one of the, it is the largest, corn crop is the largest crop that we have here in the United States. And what I'd like to do is to just bring up, where we are in the corn market and get an idea that, we've had some, pretty good moves in this thing. It made a big 3 drive to a top way back in July that we were talking about that. And then we had a really strong correction into the 786 level of this last move. That was around 570 per bushel. And what we're going to be doing now is to be looking at it on a little bit shorter term basis because we have hit some pretty strong resistance at this 786 level. And I wanted to, I'm having a tiny bit of technical problems. As most of you know, I am challenged when it comes to technical things. And when I'm working with one hand, it is even a little bit, even more challenging. But we'll get this up here. Here we go. We got it ready now. And it'll show us here that we have, if you get a chance to go into Tiger TV, you'll get a good idea that you'll be looking at this. Corn has got a lot of resistance at that 650 level, but it's going sideways for almost 3 weeks now. That's a bullish sign, folks. It looks to me like corn's building a huge base to come out, and that's one of those things that you really have. Oh, we got a call from Denver, Colorado. Are you there, Denver?
I am.
Hi, David. How are you?
I'm good, Larry. How are you?
I'm fine.
Good. Wondered if you could talk a little bit about how, on the crude oil that you were just talking about, where we're at a key level, and assuming that the market does break out, how you would go about approaching an entry to a position or approach that thought process.
Okay, what's happened, David, is, the first time that crude oil topped, it was at the 707 level, down at the 104 per barrel level, and then it went sideways for well over a month and made a, AB equals CD retracement at the 382 at $92 a barrel. And then it went up and tested the 104 level twice.
Right.
And now what's happened is it's broken out of that 104 level, and it's done it in an AB equals CD pattern. I put that into Tiger TV, and you can take a look at it, and you'll see that it measures to this 106.50 level per barrel is what we're trading at right now.
Right.
And if we get above that, then that tells us that we're heading probably to at least 114 and even 117, and it might be very quickly.
Right. But how would you?
How do I trade it? We're going to take a little break here, David. If you'll stay with me, I'll tell you what I do, because I don't do breakouts. I have a hard time, buying strings. Every time I do that, I should write my checks directly to the exchange to save the commission. So stay with us, and when we get back from the break, we'll talk. Okay?
Thank you.
Hi, folks. This is Tom O'Brien. If you want to get great trade setups in equity as well as the option market, come over to TFNN.com and test drive my daily newsletter, Market Insights, for 2 weeks absolutely free. Each trade setup comes with a profit projection as well as stop placement. Included in Market Insights is a Twitter alert service. This allows you to take advantage of intraday setups. Volatility is back in the markets. What does that mean to you? To me, it spells short-term opportunity each and every day. The days of trending up on lighter volume are gone. We have come off the highs with volume across the globe. Don't get caught in a complacency trap. Many of the indices have given back 2 months of trading in 1 week. We have a trader's market. You can take advantage of this trader's market by test driving my daily newsletter, Market Insights, free for 2 weeks. Market Insights will give you the edge you're looking for in the markets. Go to TFNN.com under newsletter. Hit the Market Insight tab for your 2-week free test drive right here, right now.
In the world of financial markets, there's a new player in town with an exciting new way to trade the markets. Nadex now offers binary options as well as bull spreads in a wide range of indices along with commodity and Forex markets. With as little as $100, you can gain access to a new way to trade global financial markets while guaranteeing that your risk will always be capped. Nadex allows you to multiply your trading opportunities in ways never imagined before and access markets you once thought were out of reach. With short-term trading opportunities available, including binary options expiring each hour the market is open, Nadex allows you to take advantage of a variety of market conditions regardless of volatility or market direction. Now is the time to take advantage of this exciting new market. Don't let this trading opportunity pass you by. Open your account today by clicking on the Nadex banner on the front page of TFNN.com. Nadex, a better way to trade.
Put the power of the Chapman Wave methodology to work for you. No matter what market you trade, what time frame you trade in, or your trading style, the opening call, Basil Chapman's daily market newsletter, is bursting with the information and trades you need to become a more successful trader.
I've been using Basil Chapman's Chapman Wave methodology for several years now. His Chapman Wave can be used for any time period for not only equities, but futures, currencies, commodities. I've been also a subscriber of his opening call, which I find an invaluable tool to help me analyze the potential of the market each day. He gives you opportunities to go short and long. It includes recommendations on stocks. I strongly recommend people using the Chapman Wave, and I very, very strongly support the use of his opening call.
To find out more about Basil Chapman and his Chapman Wave methodology, and to get your 2-week free trial of the opening call, a $64 value, visit TFNN.com today.
What type of investor are you? Conservative, moderate, or aggressive? No matter your investor personality, your overall portfolio should reflect your financial goals, time horizon, and your risk tolerance. Help ensure your portfolio is appropriately invested with an asset allocation plan from Morgan Stanley Smith Barney. Simply picking the right stocks is not enough. Research has shown that choosing the right proportion of stocks, bonds, and cash is essential to the success of your long-term investments. Morgan Stanley Smith Barney believes that a carefully selected portfolio can lower volatility and increase investment return potential. Find out about what asset allocation and a Morgan Stanley Smith Barney financial advisor can do for you. Call Angela O'Brien, First Vice President and Certified Financial Planner of the Clearwater, Florida branch at 727-441-6108 today to discuss your personal financial needs. Asset allocation does not assure a profit or protect against loss in declining financial markets. Investments and services are offered through Morgan Stanley Smith Barney, LLC. Member SIPC.
This segment is brought to you by Crocodile Gold. For more information, just click the Crocodile Gold banner on the front page of TFNN.com. Now, back to the Futures Hour.
Okay, we're back. David, are you still there?
I'm here.
Okay, the question that you asked is how would I handle it from here? And, you know, when we first started talking, I mentioned the gap that we had Sunday night. You know, it gapped, strongly above that close that we had on Friday due to some type of news. And, you know, we have rallied right into this level. And, you know, all I'm watching is it's been up 10, 11 days in a row. It's given me no indication to be a seller here. And, you know, as we're speaking, we're getting close to 107 a barrel, which tells us it probably wants to go a little bit higher. So what I would do in order to get long is I would watch the half-hour chart, and if I got a nice AB equals CD correction into that gap level, which would be down, several dollars a barrel, maybe even down as low as 103, and made a nice AB CD there, I would be looking to buy it there. But to buy it here, I have to risk into that 103 level. Right. And that's a lot more than I want to risk. So I would wait for correction, and then I would try to enter it at that point.
Gotcha. Okay, great. That's helpful.
I have one other question. My wife is listening, and if this is the David I'm thinking of, she's out of candy.
Oh, okay, good. I hope she enjoyed it.
Yes, she enjoyed it very much, and thank you so much. I appreciate it, okay?
Anytime.
All right, tell your brother I said hello, too.
Will do.
Okay, thanks a lot, David. Okay, we have another caller in from Lexington, Massachusetts. Bing, are you there?
Yes, I'm here.
How are you?
Good, good. Are you Larry or are you David?
I am good. Gong hei fat choy to you, my friend. Gong hei fat choy. Happy New Year.
Yes, Happy New Year, Larry.
What can I do for you?
I just want to say hello, Larry, and I've been following, Larry, your methodology. It's been working well with me. I'm just watching your future just to learn a little bit on the future.
Oh, good. Well, I remember meeting you. I think it was in New York about 4 or 5 years ago is when we first met, as I recall.
That's right, Larry. Yeah.
Well, that's good. Well, anything I can do, you let me know, and I'll be happy to help you, okay?
Okay. Thank you very much.
You bet. And thanks for calling in, Bing.
Okay, bye-bye.
Okay, bye-bye. Believe it or not, folks, I don't hire these people to do that. It makes me feel actually pretty good when I hear them. So Bing I remember very well because it would be it was a long time ago, and Sarah and I had just gotten married, so they're both Chinese, so it was interesting. Anyway, the question that we have on corn, and that is corn is I posted in the Tiger TV the shorter-term version of corn going over the last 2 or 3 weeks. and you'll see that at that 650 level, which is $6.50 a bushel level, that's the 786 retracement. Now, since that's formed, the market has only backed off about 15 or 20 cents a bushel. That's not very much in corn, and it's gone in a very tight trading range for the last 8 or 9 days. So what you should be looking for is to go down to a shorter-term time chart, like maybe 30 minutes, and see if you can get a nice AB equals CD pattern where you can quantify your risk. You know, all of the charts that I put into Tiger TV have that AB equals CD pattern in them because that's really what the market's doing all the time. It's either going up, down, or sideways, and what you're trying to do is to, you know, limit your risk. I mean, you buy breakouts. I know it looks really great, you know, when they go straight up, but boy, when they don't, you know, you're feeding the, you know, you're biting the hand that's, you know, it's feeding you. So it's really tough to do that. So what I would be doing is be watching, you know, the corn, you know, to make an AB equals CD, and I believe that number would come in at around $6.27 a bushel. That's about a dime from where it is right now. And I think it's got a chance to really go. I know a lot of people are, you know, really bearish commodities, you know, and frankly, a lot of these are breaking out to the upside. Particularly crude oil is doing it, and you know, we're very close to breaking out in gasoline and heating oil. Silver and gold have already taken off. Even platinum has picked up speed and has gone, you know, gone higher. So you know, this is not the time that, you know, I can see where you want to be, you know, selling any of these things. This is why I started the show, you know, talking about natural gas. That's the one that's most oversold of anything else, and because it's related to energy, the pattern is there. It's made beautiful 786 retracements, you know, all along, and so that's why I have an interest in it, is the fact that it's held up that level, you know, every time we've been on the show for the last several weeks, and so, you know, why not do that? I mean, that's the best way to, you know, to really look at that. Now, because, you know, when we're dealing with these commodities, you know, it's all related to, you know, how the dollar is acting too, because if the dollar it gets stronger, it makes our commodities more expensive in the rest of the world, and if the dollar is weak, it makes the commodities cheaper. So if we get cheaper commodity prices, you know, this is going to, you know, if we get a cheaper dollar, it's going to make our commodities, you know, even cheaper on a relative basis versus the rest of the world. And that's one of the things I don't like to do, is to give, you know, our food supply away, you know, much like we did in 1972 with the Russian grain robbery. Many of you folks don't remember that, but that's one of the things that happened. Now, I would like to switch to the currencies a bit here because, you know, we are dealing with, you know, a whole bunch of things, and one of the third largest economy in the world, you know, is the dollar versus the Japanese yen. And as you can see, we're making a really big move up into this 80-40 level in the dollar versus the yen, and that should be the top for this correction. We're up 12 days in a row. Today's a minor down day, which could be the indication that we're getting ready to, you know, have a correction. But that's something that we want to be watching, is this correction on the downside. Very similar to what we were doing with the buy when it was down at 76, because that was the 786 retracement, you know, of that whole move. And so it's important that, you know, we watch this dollar yen, because it's the third largest you know, economy in the world, and it's, you know, it's very, very important that we keep an eye on that. Now we need to look at the U.S. dollar also, because we are in the same situation here where we've had that, you know, huge AB equals CD pattern that we talked about many times. And what's happening now is we think that we are getting ready to make a 61% retracement in the U.S. dollar down here in this level of around 77. Now, if this does occur, then this would be a indication that we would be ready for another leg up, because the cycles are, we've had higher bottoms ever since last May. We've had higher tops since July. The patterns have been perfectly symmetrical. AB equals CD. The moves to the upside have been 1.618 expansions, and the move to the retracements have been 786 retracements. And, we've been basically down since, early January in the dollar, and have really only retraced 50% of the last low. So we need to get down just a little bit lower, and that would, that would make the spot, where we would want to be, getting back into the dollar and, shorting the euro. Now, the question that someone asked me about the euro is that this 133 level is very, very important in the euro, and we've actually gone above that level last night, and again this morning we've tested it again. So we are in the process of getting ready to, make a possible run to that 135, 136 level in the euro. We talked about that, several times, and it's very easy for the market, to make it to that point. But that's related to the dollar things. I need to get back to the commodities because I know it's all interrelated, but I really want to try to specialize in commodities because we've had some really good moves in soybeans and corn, and particularly soybeans, because we had focused on that several weeks ago when it was down at the 61% retracement at $11.10 a bushel, and since that time we've had a tremendous move. And the market's made a move of better than $7,500 per bushel. And believe me, if you don't think this is a lot of money, folks, when I first started trading beans and corn, beans had I think about a 12-cent range for the week, and corn had about a 4 or 5 cent range for the week. In other words, about a $200 range back in the late 60s, because corn would be trading between 120 and 125, and beans would be about 350, to 375. And now we've had these huge swings in these things, and they really make make tremendous moves. But in the last 10 weeks, we've had a big move in the soybeans, taking it up better than $7,500 a bushel. And what I'd like to do is to just show you, we talk about these numbers, quite a bit, and the patterns, the ABCD pattern especially, which is known as the lightning bolt. And I just wanted to put this in here because you'll see that we are getting close now in the soybeans to be making one of these lightning bolt patterns, and we don't want to, be buying it here. We would rather buy it if we get some type of a pullback. So that's really, what we're looking at. Someone, asked questions about the volume in the soybeans and the corn and stuff, and frankly, this time of the year is the time of the year where the seasonality is such that they're not ready for planting yet, so there's not a lot going on. But soon, starting in early March, as the ground starts to thaw, and this year there's not even frozen, so they'll plant relatively early. You'll start getting more and more farmers and hedgers coming in, doing a lot of trading, and then the trading really starts to pick up, in the commodities in the springtime, because, it's all related to the equinoxes and the seasonals and solstices and all those other things that, related to the things in the sky that help these farmers move around. And, that's why Ben Franklin wrote the Farmer's Almanac. So anyway, this is what we're looking at. We want to be a buyer in the soybeans and corn if we get a little bit of a pullback in there. And the same thing is true with the wheat market. We need to get into that also if it backs off, again, because, it gave us a really low risk buy, several weeks ago. And now this is the area where you'd be ready to take some of your profits off the board and not want to, stand in front of it. You don't want to give too much of it back. That's pretty much it. Now, there is I believe there is an ETF for corn. I'm not sure. I have never traded it, but I believe that there is an ETF for corn. It's probably CORN, but I don't know if that's it or not. But I will double-check that for the next time we do a radio show. And if I can do, during the break, the quick break there, someone has just told me that there is a ETF for corn, but it is very, very thin. Now, that if you're only going to buy a little bit of it, then, that's not a problem. But if you start trading a lot of it, then you don't certainly want to do that. If you're going to buy it for a long term, you could certainly take a look at it. I imagine that it trades relatively well with the price of corn, but I'm saying that from without even looking at it, and we'll see if it does. And I'll double check that. I wouldn't buy it yet. In fact, it's not ready. We need to get it down a little bit lower in order to see it, but I will double check the ETF for corn. I do watch the DBA as an overall view of what the market is doing for commodities, because it follows the Fibonacci numbers very nicely. It hit the exact low down there at the 618 retracement. So this was one of the things that when it was doing it, is, if you remember, this is when we started to look at the corn and the wheat and the beans and crude oil and all these things. Even gold, gold was making the double bottom down there, and silver made the double bottom. These were things that we were, saying, well, this might be a pretty good bottom in commodities, and it certainly, it's held that. So we'll have to wait and see. Now, I think there's another little break coming, and when we finish the last part of the break, I have to talk about the divergences that are happening, in the market themselves. I'm talking about the stock market, and I have to, really show you, some of the things they're very scary from a divergence, aspect, and I'll go into that after the break. But I'll post some of these in the Tiger Den, because you really need to see the differences between the Dow Jones and the transportations and the NASDAQ, and you'll see that the NASDAQ has really been masking a lot of this strength that we've been having in the market. And you always hear about Apple and all the other things, but we really need to watch these, because the divergences that we're having between the Dow Jones and the transportations and the NASDAQ, all of these are very, very important. And, it's an indication that there's something that is different than it should actually be. In other words, these markets, they should be going in tandem. It's not 100 stocks. And if you'll take a look, if this stock, the chart that I'm going to put in here now in the Tiger TV is worth, they say each picture is worth 1,000 words. Well, take a look at this one after the break, and we'll discuss it. 877-927-6648.
TFNN has an exciting announcement. As part of our Go Long America contest, Tom O'Brien and Steve Rhodes will be hosting 4 live in-person workshops that are absolutely free to attend. Denver on February 21st, Spokane on February 22nd, San Francisco on February 23rd, all from 6:30 till 9:30 in the evening, followed up by Boston on Saturday morning, March 3rd. Steve Rhodes will show you how to understand the power of 1% and how to master probability, along with avoiding getting stopped out of trades early, while Tom O'Brien will speak about the intense trading power of Tiger Gartley and butterfly patterns. All of these workshops are completely free to attend. Come see Tom O'Brien and Steve Rhodes live at one of these free workshops as part of the Go Long America Tour. For more information and to reserve your seat today, visit the front page of TFNN.com and click on the Go Long America Tour banner.
TFNN is proud to bring you the cutting edge of investment newsletters. Ken Shreve's Ultimate Growth Stocks. Ken is a top-down investor who lets price and volume in the major stock indices tell him when to be in the market and when to be out. By using his unique blend of fundamental and technical analysis, Ken will protect your hard-earned capital while realizing breakout gains. Go to TFNN.com today, click Investment Newsletters, and get Ken Shreve's Ultimate Growth Stocks free for 2 weeks.
Would you like to discover the next great tech stock? David White, TFNN's technology guru, has just launched his new newsletter, The Technology Insider. In his newsletter, David will be looking for those shining stars that may turn into the next Apple, Microsoft, or Cisco. David combines his technology background as a software programmer with his market skills as a successful professional trader to give you this unique newsletter. We're on the verge of the next great tech run. With the Technology Insider, you'll be in front of the run-up and not lagging behind. David is developing a long-term investment portfolio. Therefore, we're only offering the Technology Insider as an annual subscription with a remarkable price of only $395. That's right, for a little over $1 a day, you'll receive the fundamental technology wisdom and technical trading skills of the Technology Insider David White. What are you waiting for? Go to the front of TFNN.com, click on the link on the front page, sign up for your 2-week free trial, and become a Technology Insider today.
Here's what people are saying about Tiger TV.
Let's go to John in Tampa. Hey, John, what's going on?
Hi, Tom. How are you, sir?
I'm doing great. You having a good day out there?
A wonderful day. I love your Tiger TV. I watch it every day. I'm like a kid in a candy store.
Oh, man, I appreciate you out there watching it. How long have you been watching the Tiger TV?
I'm watching almost a month now, and it's wonderful.
It's pretty cool, isn't it?
Oh, yes, it's cool. You see the charts and everything. Thanks so much for the hard work.
Tiger TV, a great news service from TFNN.com.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pesavento's new trading newsletter, Patterns, Profits, and Peace of Mind. In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the Forex market, and more. And you'll get the Technical Corner segment, which is a short but powerful weekly training session on trading. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you just the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 weeks. Go to TFNN.com and click on the free trial link at the top of the page. That's an $85 value, yours free when you register right now. Get Larry's Patterns, Profits, and Peace of Mind and get the edge you've been looking for.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com. Now, back to the Futures Hour.
Okay, we're back, folks, and if you do get a chance to go into Tiger TV, the last couple of charts that I'm going to post are the NASDAQ versus the New York Stock Exchange Index. It just shows the wild divergence that's happening. I mean, it's an outlier event, and I don't know exactly what it means, but we're getting divergence between that and the transportations and the utilities. They are not conforming that this is a breakout to the upside. The volume's not breaking to the upside, and the VIX is, everybody's totally complacent. There's only one thing wrong. The people in the stock market do not listen to this show. I just don't understand why they're not seeing what I'm seeing, and it probably means I'm wrong. But there's another chart that you really need to look at in Tiger TV today, and that is if you'll go back to the 2007, 2008 market, what I did was, overlaid the NASDAQ over the New York Stock Exchange Index during that same time period, and it was showing you that there was virtually, no divergence at any time, with the exception of August, before the market, totally collapsed. The NASDAQ was having a really strong rally, and the New York Stock Exchange Index was going the opposite direction, down. And so that was, the start of the big move. So these are just indicators that, technical things that are telling us that there's not as much buying coming into the market as there appears, and you just need to be really careful in here. I know the Apple has been, really strong, and, some of the others have been really strong, and, now we have some of these stocks that are doubling overnight, these biotech stocks, but, those are probably one-hit wonders. We really don't know. Now, I need to get to the bond market because, the bond is a commodity, and that's something that we've been waiting for. We still need to wait. We're still at the 142 level. We've gone, virtually nowhere. We're basically still between the 786 and 50% retracements in the bonds, and as long as we can stay above this 140 level, I think we have a chance of, making one more run up into that 149, 150 area. We've been in a really strong consolidation between December 19th and where we are now. So we've gone 2 full months, into a consolidation here. So this could be really good base building. This is my assumption. And we all know how to spell assumption, ASS/U. ME. So you've got to be careful here, because if I'm wrong, this thing is going to come to the downside, and we're probably going to have to give up something to get in it. But as we go to press tonight, I still think we've got a chance, for the market to get one more safe haven run, or a flight to quality, whatever they want to call it. But I still think we've got a chance to, get to that level, and that's what I'm assuming is going to happen. So we'll wait and see, if this is going to occur the way that it is. We've had a relatively short week this week, and so next week we got a regular week, and it should be interesting, because we have a pretty strong cycle date, minor cycle. It's a good cycle date on March the 3rd, which will be, I believe, next Friday. And it should be, really interesting at that point to see if we have a good day to come in and, see if it's going to do that. Actually, it comes in on a Saturday, so the date will either come in on Friday the 2nd or Monday the 5th. And so I would give it the weekend just to be safe. So we'll look at March 5th as a week from this. Well, actually, it's a week from this Monday to take a look at it. And but other than that, there's nothing there to to take a look at anything as far as cycle-wise that I think will be doing it. Now, we will definitely come back to the full moons and new moons will start to be working soon, but we'll have to be just have to be patient. Anyway, that's it, and we finally finished the day. And everybody have a great day, and we'll talk to you Monday.